Hey everybody, hope you're doing well. In this video, I'm going to teach you ICT's new trading strategy from his 2024 mentorship. It was a long video. It was around 4 hours long, but I'm just gonna summarize each and everything, and I'm gonna explain each and everything in detail in a very short amount of time. Right? I'll try my best to not waste your time. This model is very powerful and it works phenomenally with the indices, futures, right? NAS 100, S&P 500, US 30. So it's very easy and it's very mechanical if you really think about it, all right? So the very first step is that you have to mark out the new day opening gap. New day opening gap. Now you might be asking, Faz, what is new day opening gap? It's basically a gap that is formed during the break hour. So what is a break hour? So from 1659. So the gap forms from 1659. So let me just go here. 1659 to 818, right? So that's 1659 and 18. That's when this gap forms. I'm gonna give you the indicator so it will not be complicated at all. Don't worry about it, all right? So we have the new day opening gap low and the new day opening gap high over here, and that's the indicator is going to do each and everything. All right, so what you are basically doing is you are waiting for price to engineer sell side liquidity and buy side liquidity above the new day's opening gap, right? So this is the new day's opening gap, right? I want the price to engineer sell side and buy side liquidity before 7 p.m. New York time. So that is 19 on your chart, right? So before that, I want the price to engineer sell side liquidity below the new day's opening gap and buy side liquidity above the new day's opening gap, right? So this is buy side and this is sell side. Now, we can only trade from 7 p.m. till 8 p.m. That is our trading window, all right? Before that, we are waiting for buy-side liquidity formation and sell-side liquidity formation. So let's assume that this is our trading window, right? So that is 7 p.m. or 19 on your chart. It's going to look something like this, 19, right? This is 19, right? Or 7 p.m. near time. So this is the trading window. So what you're looking for is for price to take out either the buy side liquidity that was formed above the new day's opening gap or sell side liquidity that was formed below the new day's opening gap, right? So let's assume that buy side liquidity is taken out first, right? So let's assume that the buy side liquidity is taken out first. So what you are looking for afterwards is a market structure shift. On the one, so this is all on the 1 minute time frame. You are not looking at the 5 minute, you're not looking at the 15 minute, you're not looking at the 30 minute, right? Or a daily. There's no daily bias required whatsoever for this strategy. So once you get a market structure shift, you can take your low risk entry from a PD array. So this could be a auto block, could be a fair value gap. All right. Now, you do not want to go all in from this because price can simply go up. What I like to do is wait for another break of structure. This is very important. You have a market structure shift and then you look for a break of structure. Now, what that confirms, it confirms the direction. It confirms the price is now going towards the sell side liquidity that we marked out. And also, the new day's opening gap is a magnet for price. Price will, divert towards it most of the time. All right. So this could be your draw on liquidity as well. It could be your take profit one, right? But remember this: if price engineers sell side liquidity below the new day's opening gap, but it doesn't engineer buy side liquidity above the new day's opening gap, then the setup is invalid. You must have both of these liquidities engineered. Otherwise, this model will not work. All right. So this could be your low risk entry. So for example, if you're risking 1% on a trade, risk 0.5% here. All right. And then when you get another break of structure, you can simply take your entry from the auto block or volume imbalance or a fair value gap. Now you can risk the rest of your 0.5% on this. So you are 1% in. Now, your first take profit should be the new day's opening gap, right? So you are basically taking off around 30% of your position and then you're going break even. Or when you hit 1-to-1 risk to reward, you are going break even, all right? And then you can also probably take 30% partial, but I recommend that you take partial when the new day's opening gap is reached. Now, when price goes into the new day's opening gap, you can anticipate the next move is going to be towards the sell side liquidity that we have marked out, right? So price will push towards this level over here. Now, do note that our trading window is from 7 p.m. to 8 p.m. All right. Your entry must be within these hours. This is very important. If you take entry outside these hours, the algorithm will not work. All right. It's not how it's supposed to work. So make sure your entry is from 7 to 8 p.m. in between this hour. Very important. And before 7 p.m., what you're waiting for is price to engineer sell side and buy side liquidity above and below the new day's opening gap. All right. I'm trying my best to explain here. I really hope you understand what I'm trying to say. So when this level is taken out, you are closing your entire position, guys. You do not want to hold for any longer. So you could either go for 1 to 2 risk reward as a fixed mechanical risk management strategy, or you can do this that I've taught, right? You go break even at 1-to-1. You take 30% of your position off at the new day's opening gap when price reaches this. So let me just extend it in time, right? Let me just quit it like that. Perfect. All right. So this is literally it. So if the sell side is taken out first, this is how it's going to look like. All right. You have the new day's opening gap, sell side, buy side, right? And then you have the purge. So the purge is mostly going to happen after the 7 p.m. time, which is 19, right? So from 19 to 20, that's when you get a liquidity sweep of either the buy side or the sell side. So in this example, you can see we swept the sell side first. So our anticipation is towards the new day's opening gap and the buy side liquidity. So now that we have known this, I'm going to give you guys some examples and then I'll end the video. All right, guys. So here is example number 1. And for the indicator, that's going to print out the new day's opening gap. You want to go to the indicators, type in NDOG, and the one with Lux Algo. All right, you want to use this one. Then you want to go to the settings here, and then you want to choose NDOG. So it's going to show you NDOG, and the amount is basically how many new days opening gap you want to see on the chart. So if you choose one, it's going to show you the most recent one, right? And then you can just hide the EHPDA, right? So notice what happens here, right? So this is the opening gap from 1659 to 18 is when you're going to get the new open days gap. And then what price does, you can clearly see we go up and engineer buy side liquidity, right? So I'm just going to mark this out. This is buy side liquidity. And then you can literally see that we go below and then we engineer sell side liquidity. So that happened today. So sell side liquidity, right? So we have our buy side and sell side liquidity. The model is valid. Now, what we are waiting for is for time to go to the 7 p.m. window, because that's when we're going to look for setups. So this right here is when we hit the 7 p.m., right? And then you can see we had liquidity, price sweeps liquidity, right? And this is the trading window from 7 to 8 p.m. We sweep liquidity, and what do we have here? We have a shift in the market structure. Now, this right here is going to be your low risk entry, right? And then afterwards, you can see the buy side liquidity was still intact. All right. If I zoom in a bit, you can see we didn't take out the high over here. Price left equal highs. So now the next entry would have been the rest of your position from this fair value gap. So your second entry would be from this fair value gap, right? So low risk entry and then the rest of your position here. And that's pretty much about it. You can see how price went out and took out the buy side liquidity. And afterwards, price did whatever it needed to do. But this is the algorithm that works phenomenally, all right? I'm going to give you more examples and everything is going to be crystal clear. All I ask from you in return is hit that subscribe button, hit that like button, and leave a comment if you enjoy my videos and if you find them educational, right? Let's move on to the next example. All right, guys, here is example 2, and you can see we have the new day's opening gap from 1659 to 18. That's when the gap forms. Now you can see we engineered sell side liquidity below the opening gap, and if you look before 7 p.m., so that's 19 right before that, we have buy side liquidity over here. Price sweeps it, and now what we're looking for is a shift in the order flow or a market structure shift. So when we got a market structure shift, you can see that price never came back into this fair value gap. So that becomes a breakaway gap, and price will never reach this if the drawn liquidity is here and price is going there. All right, so we want to see and we want to find an opportunity to get into the trade. Okay, this is very important because it's just going to come in handy. So now notice what happens here. We have a fair value gap formed here as well. This is inefficiency, right? Price, when is going towards the draw on liquidity, is going to go with insane momentum. It will not care about the old PD areas. All right. Now, this could be your low risk entry here, right? So let's assume that you go short here. Now, since this has become a breakaway gap, we can literally put our stop just above it, so it will not affect us, right? So entry right here, and then you can clearly see that we broke this level here, right? This could have been your entry here as well, right? Of course, this is with the benefit of hindsight, but we kept pushing down in this on this day, right? So there was only like one proper entry. You could have got it in here as well, but this would have netted you around 1 to 2 risk to reward. All right, it's very simple when you think about it. You are marking out sell side and buy side liquidity, and then you're waiting for either one of them to get purged off. Then afterwards, you're looking for a market structure shift, and when that happens, you are taking your entries. It's very simple. Let's move on to the next example. All right, guys. So here is another example. This will be the last example. So you can see we have the new day's opening gap from 1659 to 18. Then we go up and we engineer buy side liquidity, right? And then we go below the new day's opening gap and we engineer sell side liquidity. And exactly at 7 p.m., we sweep this liquidity. Now, note one thing. If there is a significant sell side liquidity that was purged before 7 p.m., then there is a very high chance that price will not come back and purge the liquidity again after 7 p.m. So for example, if you have a very significant sell side liquidity and it gets swept before 7 and you get a market structure shift, then don't look for another sweep of the liquidity, right? Look for some form of continuation pattern and then you can take your entry. Remember that, it's very important. So what is happening here? You can see we swept the liquidity. This is our confirmation that, okay, price is going towards the upside. Now you could have entered somewhere around here as well, but I like to see a market structure shift, a clean market structure shift like this. Price goes up and leaves behind this fair value gap. This right here is from where you could have taken your entry, or you could have taken your entry from this fair value gap that formed after a break of structure, right? We then had volume imbalance here as well. So this gave you enough confidence that the PD areas are being respected. And what does that tell us? that price will not go towards the buy side liquidity that we marked, right? So if you entered somewhere around here, you would take 30% of your position somewhere around here, right? But if you enter somewhere around here, then you are in for a beautiful ride. You can see we had this gap over here. Price filled in this gap, and PD areas were being respected until buy side liquidity was taken out. Got another fair value gap, gets respected. It keeps happening until we hit this level. So go and practice, guys. It's not going to be, you cannot just go to the live markets and start trading this. You will need practice. You will need to see how price moves and how price books liquidity and moves. Please remember the thing that I taught you, that price can sweep sell side liquidity or buy side before 7 p.m. and then proceed to go up. Even before, like it can sweep the liquidity before 7 p.m. All right, if there's a significant one. All right, but there's a minor one, like for example this, right? We only have a low, then you are looking for a sweep at 7. So remember that. Anyways, that would be it for this video, guys. I hope you enjoyed and learned something from it. I'll see you guys in the next one. Goodbye.